Experienced option traders trade options for several different reasons. They want to be able to use leverage so that they can double and triple their account sizes. Options also allow traders to make money on both sides of the market. After all, the stock market moves up 50% of the time and down 50% of the time. Options allow profit when the market moves up, down, or sideways. With options, you take control of your probabilities. You choose your own win rate. There are many strategies that allow you to profit much more than 50% of the time. You can actually choose to have a 70, 80, even 90% chance of being profitable. That's called probability in the profit. That's much better than the coin flip of the stock market, at least in the near term. Sometimes traders want to reduce their risk and hedge their bets against their long positions in their portfolios. You can do this with options. These are all great reasons to trade options, and this certainly can't be done just by buying stocks outright. Now, most beginner option traders want to learn about trading options so that they can create wealth. Absolutely nothing wrong with that. Me too. Now, this is where new traders run into trouble and they underestimate the risk of trading options. In this video, we are going to cover what are the main problems with trading options, what is the biggest risk with trading options, and how do we greatly lower our risk trading options using two specific rules. And we'll go through a couple real examples on the option trading platform and show exactly how it's done. Hey guys, Darren here. We've got a great video for you here today. But first, please hit that like button so we can get this video out to more people. Today we're covering options risk. I think it's super important that we understand the different ways that the rich are getting richer so that we can use similar strategies and profit together. I promise we're going to dig into many detailed option trading tips and tricks in this video and future videos. So after you hit that like button, make sure you subscribe so you're informed of the new videos coming out. Also, be sure to download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. What are the main problems with trading options? Guys, there's one glaring problem that really stands out about trading options. Options are not a store of value. Options are financial instruments with a specific purpose. They can be used to implement leverage or reduce risk on an individual trade or entire option trading portfolio. The best way to increase wealth over time is through owning stores of value. You want to increase your stores of value over time. A store of value is something that does not depreciate over time, but instead appreciates over time. Real estate, gold, actual shares of stock in proven and growing companies are all stores of value that do appreciate over time. You can buy them as a passive investment, not look at them for 10 years, and then take a look and see that they've increased in value over that time period. With options, we just can't make a trade and then go to the beach or play the guitar in the back of our van. Because options are not a store of value, they are not a sustainable way to grow long-term wealth by themselves. In other words, having 100% of your investments in options is not the smartest or most realistic way to build wealth over time. What is the biggest risk with trading options? You can blow up your account. Since you are using leverage when trading options, you can lose a lot of money. However, because options allow us to use leverage, we don't even need to do that. We don't want to be too greedy. You only need to use a small portion, maybe 10 or 20% of your investment dollars to complement and further grow your wealth. We can use leverage to both grow fast while also reducing risk at the same time. How do we lower our risk when trading options utilizing two specific rules? There are some option trading rules that I have used that have saved me a lot of time and money quite a few times. And I probably should have used them a couple times more. There are so many option trading rules, so I'm going to cover two of the top ones. If you just do these two, you will greatly limit your chances of getting in trouble with your option trading account, and most importantly, avoid losing a lot of money. Rule number one, don't trade too big. I recommend that you only use 30 to 50% of your available buying power or option trading account value when trading options. The lower end of that when the market or the S&P 500 is above the historical average and long-term trend line. As mentioned previously, we are already using leverage, so we can outperform the market and stocks using much less capital. So there's really no reason to use more than 50% of your buying power. Beginners often have a little success and see big gains and the potential, and then they become greedy. They don't realize that they're going too big until it's too late and something happens and they lose everything. Rule number 2, know your trade risk exposure to the downside. Markets and the total S&P don't normally explode up 25 to 30% over a short period of time. It typically moves up slowly over time and incrementally. So I never really am too concerned about my short position exposure, even though I trade both sides of the market. However, the market can move drastically to the downside very fast. We never know when there will be a war or political event, banking or housing crisis, or even a pandemic. Hopefully not anytime soon. Every few years, something happens that causes the market to drop significantly very quickly over just a few days. This is when you can really get hurt trading options. Even if we have uncorrelated positions, when an event happens suddenly, everything becomes correlated and all positions go down. So you need to know where you will be P&L wise in your portfolio should an unfortunate catastrophic event occur and the market drops 30% or more very quickly. How do we do this? We look at our total option buying power in our accounts. As in the previous rule, I like to stay between 30 and 50%. This way, when something does happen, I can invest more and take advantage of the sale. All right, we're going to take a look at a couple of trades and really break down the buying power and max loss that can occur should there be an event. You can do this with any brokerage on any platform. We are using the TastyTrade platform. TastyTrade is one of the best brokerages for trading options and one of the best platforms. It's the one that I've used for several years, and they are the guys that developed TOS, the Thinkorswim platform, and sold it to TD Ameritrade, which is now Schwab, and the one they still use today. TastyTrade is even better. Right now you can get cash back when you open an account. I'll put a link down below, and if you fund with at least $2,000, the channel does get a small fee, which is much appreciated. There's absolutely no cost to you, and you need a couple $1,000s anyway to place a few different trades. Here is an example of selling a 25 strike put option in Chewy. The current price is $27. We collect $1.40 per share, which is really $140, since one option contract equals 100 shares. We can be assigned and forced to buy and own the shares at the $25 strike price if the stock price moves below that price prior to the October 20 expiration date. The buying power that we are using is only $307. However, look at the max loss. It's $2,360. This is because if the stock price drops below the $25 strike price, we will own those 100 shares. Then the value of the 100 shares is $2,500. However, we collected 140, so our break even is the 2,500 minus 140 collected, or 2,360. If the company went out of business and the stock price went to zero, this is the amount that we would lose. Since we're only selling puts in good companies, it's very unlikely that this will occur. However, what if there was a major event and the stock price dropped 30% from the $27 price down to $19? The $23.66 is our break even, so we would lose the $23.60 minus the $19, which is the new current stock price, and it would be $4.60. Since there are 100 shares, we would lose $460. Notice the buying power reduction, BPR, was only 307, since it is not expected that it would drop 30%. However, if it did, you can see we would actually lose even more than that. The nice thing is that we would still own the 100 shares of stock that were put to us, so we could hold the stock until the market came back. Remember that stock and not options are stores of value. Now let's look at another trade and selling a put vertical spread. Tesla is currently trading at $254 and we sell the 225, 235 put credit spread and collect $3, which is $300. We can be assigned and forced to buy and own the shares at the 235 strike price if the stock price moves below that price prior to the expiration date. However, we also own the 225 put option, which we bought. The buying power that we are using is only $700. This is because the max loss is the $10 width of the spread minus the $3 in premium collected, so it's $7 or $700 since the one option contract controls 100 shares of stock. Now, what will happen if there's a quick 30% drop in Tesla? The price would drop from 254 to 178, so we would definitely be at max loss and we would lose $700. Now, in this case, we were completely blown out and would not own the shares or store of value since we bought the put option as well. We could not hold the stock until the market came back as we could with the short cash secured put option. Remember that stock and not options is a store of value. Just think if you utilized only vertical spreads and they were all complete losses, you could cut your account size in half or worse. This is why we want to stay small and trade both sides of the market. If half our positions are short, then we only lose half the amount that we would if we were completely long or bullish on the market. So some of the key takeaways that we want to keep in mind are we always want to trade small and have at least 50% available buying power available in our option trading accounts. Most uncorrelated positions and industries will suddenly become correlated and all drop together in certain bad events which happen maybe every few years. Markets can move fast and we always want to be aware of where we will be in our options trading accounts if the market were to drop significantly like 25 or 30%. We want to understand that although defined risk, there is often no coming back from vertical spreads and they will be complete losses. We want to trade both sides of the market as well. All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, hit like and subscribe. Let me know in the comments below what you're trading, what you'd like to see. I will be sure and respond to your comment or question. There's also a paid course as well as coaching available. Thanks for watching. See you in the next one.